Greetings and a very warm welcome to all of you. Very happy to connect again with you through this video. I am Sundar, founder Canary Capital Solutions. A lot have changed in the last couple of weeks with the world slowly unlocking and getting back to normalcy, and we are breathing a lot more easily than what we were in the last couple of months. Opportunities are found in extreme pessimism. It is not the strongest of the species that survives. It's not the intelligent which survives. It is one that the most adaptable to change always survives. A famous quote by Charles Darwin: from socializing to social distancing, humankind has slowly transformed itself and adapted to the new normal, right from social distancing to wearing a mask. And as we have started moving, even the data is suggesting that things are getting back to normal slowly and steadily. The first chart is about the airline travel, where the number of flights departures have increased to about 600 to 700 in the last couple of weeks, and even the passengers traveled every day has increased to about 60 to 70,000. The second chart is about the overall toll collections. So if you look at during the pre-COVID, the toll collections were going up very well, and by the month of March and April it dipped to a new low, and now slowly we are seeing some kind of a recovery. So getting back to normalcy, some more data. So if you look at pre-COVID, the number of FASTag count, meaning the number of vehicles which passed the toll, were about almost 110 million. From that, in April it dipped to about 10 million, which is almost a 90% fall. And during the month of May, we are back to about 55 million. And hopefully June, the numbers will be even better. Similarly, the GST e-way bill registration in February 2020, before COVID, it was about 57 million. It fell to about 8.6 million, which is again a 80-90% fall. Now again getting back to about 25 million. So slowly and steadily we are moving forward. There are also other disturbing headlines, not only the COVID. There were a lot of tensions between India and China, US and China. In US there were a lot of riots happening across the cities and towns. Moody's have downgraded India, and so on and so forth. So there were so many disturbing headlines, but in spite of that, the markets across the globe have performed extremely well. Right from the Dow Jones to Hang Seng to the Indian markets, most of them have actually done extremely well in the last 1 month. And many of the investors are puzzled, not knowing why it is. One reason behind is, before going into the reason, let's see how US markets have reacted. It is in fact at a 1-year high. In fact, it is at an all-time high, even surpassing the pre-COVID levels. So that's how the Nasdaq, the US markets have done well, and the reason is the Federal Reserves are in action. If you look at all the major economies, all the Federal Reserves, right from the US to the European Union, Japan and UK, all put together have pumped in a lot of money and created a lot of liquidity in the last 2 months. Even during the global financial crisis this happened, but the swift and the speed in which it has happened this time is much more faster. And in the last about, if you look at this chart, where there is a steep increase in the balance sheet of all the G4 central banks, which means about $3 to $4 trillion have been pushed into the market, which is actually acting as a big support to the market. Even in India, a lot of actions have happened, right from the fiscal to the monetary side. RBI has cut down rates, and we are at an all-time low, historical low when it comes to interest rates. And the government has also announced a lot of fiscal measures, credit guarantee schemes, and also there is expectation that once the COVID number starts coming down in India, maybe further more stimulus is expected. So what is the other most important thing which is happening apart from the liquidity in the market? There seems to be some kind of vaccine in sight. As we speak, there are about 90 companies which are at the human trial levels, and some of them also have found a lot of successful reports of the drug working, and some companies have also started in terms of manufacturing in large doses, like the Pune Institute, the Serum Institute in Pune. They've actually started manufacturing in a big way. So there is a lot of hope that the vaccine will be around the corner in the next couple of months or in couple of quarters. So that's giving a lot of positiveness to the market. The market is actually moving from a pendulum from the fear psychosis to a hope psychosis, where previously there was increase in COVID infection, there was a fear of second wave infection. Of course, all those fears still stay good. Delayed resumption of economic activities. Fortunately, the most part of the world is opening up. The lockdown extension seems to have come to an end, at least for the current situation. The India China border dispute, which is currently on, but market is actually looking slightly on the hope side, where there is a decrease in COVID infections. In fact, some of the hotspots across the world, including the Italy and Spain, have already peaked out. In fact, Italy is open to normal. In fact, the movie theaters have opened in Italy last week. The medical breakthrough looks like possible as we speak today. Normalcy in economic activity, we saw some data including India that a lot of economic activity has started. Fiscal stimulus executions and also the monetary stimulus executions. There are some other positive news also. As we speak, our forex reserves have actually crossed $500 billion, which is a all-time high, which has never happened in our country. It's been slowly and steadily growing, and it is now sufficient for about 12 months of imports. And also, if you look at the current account deficit of India, is again close to about 0% of GDP. In fact, there is a high probability next year we can actually have a surplus. And also, a lot of capital raising is happening in a situation where there is entire panic, and there are many companies which are starving for cash and capital. Some good companies and some good businesses are able to raise, and Reliance has actually raised about 1,15,000 crores in this last 1 month, which is one of the biggest records ever in this country. And also other newses like GSK company had bought over HUL's Horlicks brand. Kotak Mahindra has been able to raise successfully, and there are many other who were able to raise capital even in this situation. Coming to market valuation, in spite of all happening, the valuations are still at a multi-year low, in fact at a decadal low. If you look at market cap to GDP, we are currently about 56% market cap to GDP ratio. During the March lows of market, it was almost about 48%. From there it is recovered, but even then it is still much way below the averages of about 75%. It is not only this year phenomena. If you look at the last almost 10 years, most of the time we have actually traded less than the average market cap to GDP. So this is a very interesting data point to invest or allocate more money towards equity. The next is the price to book ratio. Again, if you look at it, is at a decadal low kind of situation. Even after a small recovery, we are still far below the averages of about 2.6. And this is a very important slide and a chart which we all should understand. Across market categories it is low, but if you bifurcate the Nifty and the mid cap and the small cap, the differences are large actually. If you look at Nifty is at a 2017 low, which is about 3 years low. Mid cap is at about 2016, which is about 4-5 years low. Small cap is at almost at a 10-year low, which is almost a decadal kind of a low. So there is a lot of opportunity in the small and mid cap space, though these are high volatile segments compared to the large cap, but the risk reward ratio is very favorable for investors who can stomach the volatility and who have a large longer time frame. They can actually try and allocate more money in mid and small cap, provided their asset allocation allows them to do. And whenever the markets falls or whenever there is panic, this is one thing which is very common in the markets. People try and pull out money because of the panic, because they can't see money going down. in front of their eyes. So there are people who also discontinue their SIPs. This is a very interesting chart again. In the last about 20 years, there are about 15 instances where markets have actually fallen by more than 10%. And people who have continued SIPs have made money during these troubled times, and people who have stopped SIPs have actually accumulated much lesser wealth than what they could have done otherwise. Just a comparison, somebody who has been doing a SIP of 5,000 rupees for the last 20 years would have invested 12 lakhs. In spite of all the ups and downs, he would have actually generated a corpus of about almost 61 lakhs. Somebody who stopped on every fall whenever markets have been falling because of the panic, he would have actually invested about 7 lakhs, but the corpus what he would have generated is only about 30 lakhs or so. So ideally, these are the times when markets are low. That's some of the times where you should definitely continue your SIPs, because that brings in a lot of discipline and eliminates the panic in the market, and also the rupee cost averaging works in your favor. So this is the chart which I showed in the previous video also, during the coronavirus started during the March-April times. The COVID, the SARS and the other viruses have been made the markets fall, but eventually markets have gone up in the next 1 year. Even as we speak, during COVID, markets have fallen 30%, but in the last 2 months there has been good amount of recovery, but we'll have to see what happens 1 year from now. So our mind always looks at linear returns, but the reality is market never gives you linear returns. So it's not that every year the money what you invest keeps growing. Market always goes up and down. Not only equity markets, any asset for that matter. Gold keeps going up and down every day. Real estate also goes up and down. Of course, we don't get the prices every day, but if we have an index to track real estate, even real estate will go up and down. But eventually all these assets actually deliver higher returns in the longer run. Just to summarize, continue your SIPs if you have the ability to increase your SIPs, because some of our expenses have actually fallen dramatically in the last 2-3 months, and it is also likely to continue for some more time. So if you have any surplus and you are sure of keeping that money aside for the next couple of years, definitely it's a great opportunity to increase your SIPs or top up lump sums at the current level. If you are an aggressive investor and understand the volatility of small and mid caps, you can definitely increase your allocation towards small caps at the current level. And also pharma as a sector has started doing well, and some of our investors who had taken position in pharma in the last about 1 year, they've made about 35-40% absolute, and it looks like it is just the start of the pharma rally. Also banking, because of all this negative news around, seems to be beaten down. Maybe in the next couple of quarters it should somewhere stabilize, and we can also start allocating. If you have a sector view, banking looks interesting in the next 3 to 4 years. A simple piece of advice: stock market is a device for transferring money from the impatient to the patient. So as an investor, stay patient. Just focus on your input, like how much you can invest and how much expenses you can reduce. Return is just an outcome. That is an outcome which can happen only if we do the input right of investing and reducing our expenses. Please do subscribe to our YouTube channel. So we keep uploading a lot of these videos. We also are available on Facebook in the name of Canary Capital Solutions. We also conduct a lot of financial awareness sessions and other webinars. Please do get in touch with us on the given numbers for further updates. Thanking you.